Hi everyone, welcome back to the Property Finance Podcast. And today, carrying on kind of our FAQ series that we've done over the past few months, I want to talk about when you get a set of development terms, you often find that you've got the gross drawdowns, the net drawdowns, net day one, gross day one, all of these different things. And it's very difficult when you're looking at a set of terms for the first time to kind of look through them and understand straight away, oh, okay, that's what all of that means. So I kind of wanted to give a bit of a breakdown of what gross versus net means. And then also just, I've done a podcast previously about rolled versus retained, but we'll bring that into all of this as well. So what you'll tend to find is when you get a development finance DIP, decision in principle, you'll be presented with a set of numbers, most of which start off at the very top as a gross loan. So what that normally means is the gross facility is everything. That's all your fees, everything that you're borrowing, interest roll up, absolutely everything included except the exit fee. So what you tend to find is that the amount you have to pay back will be somewhere in the region of that gross loan. And then what will happen is they will add that exit fee on top. That exit fee might be 1 to 1.5% of the amount borrowed or of the gross loan. Now, what happens is they will calculate that gross loan based on normally 65% loan to GDV. So what tends to happen is they will work out, so let's say your GDV is £1 million for nice round numbers. They will then say, right, okay, your gross facility is 650,000. What they then do is they work everything off of that 650,000. So all of your arrangement fees are based off of that. All of the interest is based off of that. So they assume that you are borrowing £650,000. Now, this is where the difference between the gross and the net comes in. Because what happens is they work out all of these figures based on the gross loan, and then you are then left with the net figures. So the net figures is what is sent to your solicitor, for example. So your net day one drawdown is what would go towards purchase. Your net build costs is what you would have access to for the build. So the difference between the gross and the net tends to be your arrangement fees, interest, everything else. Now, what happens is if you work out that net plus all of the fees and everything else, so what you tend to find is that net loan obviously is significantly less than the gross loan. By the lender doing all of their interest, fees, everything else on the gross facility, it is to your detriment, because what happens is, let's say your net facility is £500,000 for argument's sake. So there's 150 grand's worth of fees, interest, everything else. Now, what you'll tend to find is your arrangement fee, let's say 1% of that gross loan so that gross loan, £650,000, 1% of that, £6,500. However, your net loan is £500,000, which we just mentioned. But if you did 1% of that, then all of a sudden it's £5,000. So what you tend to find is actually you're being penalised because you're being charged fees on essentially your net loan plus the interest and fees. So you're essentially paying fees on fees and interest on interest. So that's where the gross and net can get quite messy. And that isn't always massively clear normally through DIPs. So we've started to push more towards lenders now that charge fees based on the net drawdown. Because it is more cost effective for the client, obviously less interest, everything else. However, that isn't always possible because obviously, depending on what your deal is and who it fits with, we may be forced to use a lender that goes off of the gross, but we do try and push towards the net. We are also, when it comes to rolled and retained interest, so if you have rolled interest, what happens is coming back to that gross and net. Rolled interest is where they charge you interest on what you've actually drawn down. So where we mentioned earlier, you've got the gross loan of 650,000 and the net loan of 500,000. You're only going to be paying interest on the 500,000. You're not going to be paying interest on the 650. So they work interest based on what you've actually truly drawn down. So you're not paying interest on interest. Because what happens in the gross loan facility is, let's say that they're doing retained interest. They take that 650 and then they work everything on the basis of you drawing 650. And then obviously all their interest calculations are against that. So you're essentially paying interest on interest that they've already thought that you're going to have. So it all gets very messy and very costly for the client. So in terms of rolled versus retained, it's always more cost effective to go for rolled interest because it's based on that net loan. And when you're working on development finance, it's always more effective to go for lenders who are charging fees on the net loan and interest on the net loan rather than charging everything off the gross loan. All of this will be explained in a DIP. Obviously, if you go for development finance or bridging finance, this is the same for bridging finance as well, or refurb loans. All of this will be explained on that DIP, but it can be very, very difficult if you're just glancing at a bit of paperwork to go, oh yeah, okay, I understand what that means. You're not going to have that. So that's obviously why people use brokers. So by having that sort of in front of you, by discussing it with your broker, you should then be able to look through and work out which one's kind of the most cost effective for you. So Hopefully that was helpful. Gives you just a little bit, it's a very quick episode, just a very quick insight as to the difference between gross and net and the difference between rolled and retained. But hopefully that will save you quite a bit of money in the future, obviously when you're comparing lenders. But thank you very much for listening. Catch you on the next one.